So yesterday, the 5th of January, the markets looked, well, they looked like they were set up for all-time highs, new all-time highs. And then 10 o'clock rolled around, and I believe that's when we started to see the liquidation sale that we experienced through 1 p.m. to 3 p.m. Central Time. In this video, I'm going to talk about indicators that I believe could help you become a better aware of what markets are doing, how they're performing, how they're going to perform in the near future, and if you're on a day trading type thing, can give you indication of rotations like we saw yesterday on the 5th. All right, so I started out the day just like everybody else. I have talked many times in videos about price, volume, and volatility. Yes, I cut my finger today. And one of the things that I, reflecting back on last year, have realized why I had the, crappy performance I did was, number one, I felt like I always had to have a trade on or an investment put into place. I always had to feel like I'd be in the market. Sitting on the sidelines just internally just did not feel well. So patience was lacking last year. Number two, getting off course of what actually worked for me from the beginning of the year through September. And I remember a video where somebody commented on one of my videos. I was in Savannah, and the guy or gal said, "You do not seem as confident as you usually do." And looking back now, they saw what internally, subconsciously, I felt not confident about what I was doing. And that blew up the rest of my year, because that lack of confidence and lack of stepping back and just saying, wait a second, I don't understand. And number two, I got to be patient, worked against me in a big way. I will recover that because I realized my mistakes. And I think we all need to do that at the end of the year when we have been looking back. Where did we win? How did we win? What was the process? What was the mindset? So I've implemented a couple things this year. Number one, I've started journaling every day. Part of this was motivated. I was motivated because I went to the doctor the other day, and it's a doctor I've been going to for a couple years. And every 6 months I get blood work done for a handful of reasons. But what he has noticed in this is that my triglycerides, I believe, have been continuously going up, which basically makes me potentially in the situation of, in future years, becoming diabetic. Well, I don't want to do that. I'm 52 and young, I'm active, blah, blah, blah. I'm in pretty good shape. And what I realized is I need to change my behavior, but I also need to start tracking my data, and I need to start journaling every day. And journaling means not just when I wake up, what I eat, how I exercise, how my day was, how my mood was, and when I went to bed, but also incorporating that element of what I'm doing when it comes to making my money work. Where am I winning? Why am I losing? Those kind of things. And because I'm journaling it, I now can go back and look at what was the situation that created a win versus a loss. And so I'd encourage you to start journaling your investment strategies along with keeping up with just day to day. It helps out. But anyways, let's flip back to yesterday. At 10 a.m. Central Time, and I'm using SPY because you can track volume, and I have found this volume zone oscillator, which is really insightful and gives you insight to what is happening in the volume of a position. You can get down to a minute or per tick or whatever, all the way out to days and hours. And what I have found with this is it is a leading indicator, as I've talked about in past videos, that volume is a leading indicator to what is to come. So you can then front run that move in that position, if it's stocks or bonds or crypto or what have you. But volume is very telling. So at 10 a.m. yesterday, the SPY was at 477.31. The 11th hour at 11 a.m. it opened at 476.54. All of a sudden, you're starting to see opens that are lower than the previous open. So we're starting to staircase downward. At 12 a.m., we went to 475.94. And then at 1 a.m., 475.84. Not too much of a change, but remember, at 1 a.m. or 1 p.m. Central Time, the Fed minutes came out, and then all hell broke loose. And that's when we saw a move from 1 a.m. to 2 a.m. from 475.84 to 471.70, and then closed at 3 p.m. at 468.38 on SPY. That is roughly a 1.87% fall in the price from 10 a.m. Central to 3 p.m. Central Time. Now, does this create a buying opportunity? Of course it does. And if you got in early this morning and you did it quick, you made some money. Or maybe this is a turn that we're making a move back up to that 10 a.m. on the 5th at 477 price point. And maybe we'll hit all-time highs. But here's something I think we need to take into account. For 2 years, we've had more than 20% gains in the S&P 500. 2 years in a row, more than 20%. If you caught the March lows of 2020 and you just bought SPY or SPX or bought just long-term leap options, you've made a boatload of money. The problem is 20+% consecutively for a third year. What would drive that to happen? If you went back and look at the Fed minutes, they indicated that they're going to raise interest rates 4 times, which was the catalyst for this spook in the market that spooked it to drop roughly 1.87% from 10 a.m. to 3 p.m. This is pretty significant because if you think about it, if you start to raise interest rates in an environment where you're starting to see a deflationary environment, where price of goods such as commodities, lumber, gas, oil is starting to fall, so you're deflating. Now you're raising the cost of money, so federal funds rate. All of a sudden, you're going to start to see a slowing in those commodity areas. You're going to start to see a slowing in other areas because the cost of money is going up. And if cost of money is going up, I'm less likely to go borrow money because it's going to cost me more versus a month ago or 2 months ago or 2 years ago. And so this rise in interest rates is now going to create an environment where you're going to see a contraction in the economy, in my opinion. This is, of course, not advice. This is just my opinion about what's happening. So where do you go with your money? Well, number one, I do think you're going to get a bounce off of yesterday's 468.38 close on the SPY, and you may get up to all-time highs. But in the long term, say 3 to 6 months, I'm more thinking that we're going to see a slowing of things, and we're going to see earnings come out after the first quarter, if not this past fourth quarter, that indicate year over year things are not as great as the year prior to that. Does that make sense? Anyhow, but so you get what I'm saying. I think we're entering the top of the bell curve and we're starting to head downward. And so where do you go with your money? Well, this is something I was talking with my ex-business partner today about, is where do you start shuffling money? If we're not going to spend more money on more capital spending from a corporate standpoint because my goods aren't in as demand as they priorly would be, and my earnings start to show maybe less and less, I'm going to become defensive, and I'm going to start to look at things that, well, in simple terms, maybe they pay a dividend. And I'm also going to start moving to where if the economy starts slowing at a rapid rate, I'm going to go to more defensive places like treasuries. So things like TLT, which is a mixture of 10 to 30-year term U.S. treasuries, could be interesting. Utilities, REITs, things that pay you a paycheck for holding them, dividend type stuff, and less on the growth side of things. Now, short term, the growth side, the volatile NASDAQ or triple Qs or something like that, yeah, sure, you can make some money. But I think long term, we're starting to turn the corner and we're going to start contracting as an economy. And we're going to start to see what did well for the last 2 years is not going to do as well. So that brings up, financials pay dividends. My bank stock pays dividends. Is that a place to go? Well, if money costs me more to go borrow to buy a house, say from today versus a year from now, who's going to pay for that? Well, banking institutions are going to possibly pay for that because if I'm not borrowing as much, they aren't making as much, and so they're not lending as much, so they're not making that spread. Now, what money they do lend, the spread will get bigger because the federal funds rate will go up because the Fed said they were going to raise Fed funds rates 4 times, right? So I'm looking for areas where I have to have it. Utilities. REITs, possibly a good place to be because they're when it comes to long-term leases, on corporate leases, those kind of things, they pay a little bit better, and they also possibly adjust within those commercial lending side of things based on the cost of running that piece of property, and they pass that on to the person or the company who is leasing that property. So it could be a good area. And then, of course, a defensive position in U.S. Treasuries. With this whole Omnicore, or I refer to it as the unicorn variant of the COVID, and to those who have had COVID, I hope you're well and I hope you're recovering, but I don't think this is something that is going to stop. We're already seeing the Wall Street Journal. They were talking about how K through 12 schools are going back online because the teachers and staff are getting sick. I've seen it over the last month. More and more of my friends are starting to get sick. And so I think you're going to see some hesitation possibly from those states that are really real conservative or liberal or what have you about this, and they're going to start to close up shop a little bit like we saw 2 years ago. Now, I live in Florida, and some of you may have a strong opinion about our governor, but the way you walk around Florida, we don't have sickness. People are doing their thing. They're doing business. And we're seeing more and more floods of people moving here from the West Coast and Upper East Coast down here. And I think also for tax purposes, but also because we have an environment of, we're just not locking down. We're not mask oriented, that kind of thing. All of this said, I think you're going to have the majority of states potentially being in a situation where they start to lock down and they start to require masks and they start to require these things. And you start to see schools saying, you know what, you stay home because, well, number one, our staff is all sick. And number two, we don't want your little kids' sickness and ick, right? I mean, that's how old adults get sick when they have kids because the kids bring it home from school. I think you're going to see more and more of this go back online, which brings up, is Zoom a stock to buy? I don't know. I think it's been sort of played out to an extent, but it could be because if we do see this shift again, especially on a college level, and according to my daughter Emma, her friend who goes to Tulane was told to stay home and to dial in because they're doing online classes. Now, New Orleans is interesting, very locked down, can't go into a restaurant without a vaccine card, can't do much there. And I think you're going to see potentially more universities do that, more like on the West Coast. I heard on the West Coast that a lot of the universities are saying just stay home, that kind of thing. That all said, think of it as a bell curve. It's been killer since July of 2020, and now we're at the top of that bell curve. Supply chains have still been struggling a bit. Now we're comparing year-over-year numbers starting end of first quarter, so the start of the second quarter. And I gotta believe those numbers are not gonna be as good as the prior year. And that is going to start to create concern in the investment community, into economics on a global scale, and you're going to start to see us roll back in to some sort of recessionary environment as we get into second quarter and second half of 2022. So position for it. Start looking for that. Watch the volume. Check out that volume zone oscillator. It's very telling. It was telling at 10 a.m. yesterday that we are about to see some heavy selling coming that way. As it today is indicating a move up from a negative to a positive slowly, not confirmed or anything. Like I said, do your homework. This is not advice. But I think we're in a turning of the corner. And with that said, please hit the subscribe button and the like button and look for my next video in the next couple days as this all develops. Take care and live loud.